Good evening. Welcome to the live FB tonight. And tonight we have a special VSA 360 tutorial, right? Pretty much to explain some of the benefit, how you can select the FA growth list. And that's really important, especially in this bear market in here in the context, and how we are able to find those growth shares and yet the background behind it, which is looking for fundamentally sound stocks. Let's get started. We'll really appreciate if you could also share this video in your timeline that more people can enjoy. And let's get on to the VSA 360 fundamental in here. All right. So welcome tonight to the TradeVSA Special Edge. This is part of our 5-part series that we'll be doing every Wednesday night for the month of June in here. Now tonight we'll be talking about identifying growth stock. What is growth stock and what do you mean by growth stock? What do you look at? How does it make money in the future? If I buy it, what happens what should I do if the market falls? And these are the questions we will attempt to answer you, especially some of you who are beginner. Now, those of you who are beginner in here, just type one in the comment section here. Really appreciate that. And also, right, give us a thumbs up if what we are sharing with you now can be helpful in your day-to-day and slightly longer term investing. All right. So let's take a look on what we have. This is the disclaimer in here. Some of the stocks that we talk about in here, we do have interest in it, and we might just bought it in here. Of course, don't forget to subscribe to our YouTube channel and hit that subscribe button in here. Pretty much we are doing in here. Now, as I said before, we are at part 3 of our five-part series that we've been doing here with TradeVSA for the month of June in here. Last Wednesday, Zach was doing the identifying sector and understanding trend. So this week, we are going to be identifying growth and looking at some of the FA counter, and of course we make it so much simpler, both combining the best of both worlds. Now you may know there's a lot of people out there just merely using fundamental FA. They do not use market timing, so what they always do is try to average down and buy. But there is also some of those who don't look at the fundamental and just buy anything that move. Looking at it, then there's a lot of investing. But what we do here today, we're combining best of both worlds, both FA and TA, where FA looking for fundamentally sound growth stock, and the TA, which is using volume spread analysis, looking for the best market timing, and of course no other than using our Pentagon Guider, which is available in the trading view chart as well in our VSA 360 in here. Next week we'll be talking about the 3 steps to create a winning trading plan. All right, let's get started in here. Now let's say right now we're in this bear market in here, and you're trying to make money to see what kind of stocks that you want to buy, but you really don't know what to buy and sell. Should I buy in this market in here? There's so many opportunities that I'm seeing in here, and what are the things that I should look out for? And do I have to analyze the stocks every day that comes across in here? Since what you said, Martin, is a lot of opportunity. Now this is time consuming and of course very boring in here. So I'm going to share with you a very simple tools that you can access to it, definitely tonight in here, and analyze those stocks and start investing automatically, where you see a lot of upside in here. And it will tell you when to buy and when to sell, definitely by using the VSA 360 in here. Now, of course, let's do a quick test in here. If you have a technology stock on Inari, what you see in here, Inari and Unicef, what would you do here? Right? Let's give me an example here. All right, first thing first, you would look at this company, and what are the things that you'll be looking at? These are technology shares, right? Now remember, technology shares, they make and sell phones, the semiconductors, health computers. So these are what we call growth shares. Now going forward, as more and more people will be buying phones and laptops, the semiconductors as well as the technology share will grow. So this kind of company, should you buy right now? The right answer is definitely yes, because why? We are seeing this temporary downturn in this bear market in here. But when the market go back to a growing move, especially when the inflation is much more controlled, you'll see many of these stocks will continue to go higher in here. If you agreed with what I've just said there, type it into the comment stocks inside there. All right. Now let's take a look at the next one, where we'll be talking about rubber glove sectors. All right, now rubber glove sectors usually look at the average selling price. Now we all know the average selling price continued to be lower. This is due to competition prices, as we see many competitors, rubber maker coming into the industry. That has brought down a lot of this supply higher, right? And demand has started to dwindle in here also, because right now the market is opening the economy. The number of cases of COVID has also down. But also take note, the labor shortage that we're experiencing in Malaysia and the fuel costs due to the Russian-Ukraine war in escalating higher costs and putting cost pressure and lower profit margin in the days to come. So in this rubber glove sectors, what would you do? Would you buy, hold, or sell if you have stocks? What is your answer? Right? And the answer is fairly obvious. You want to likely to not buy. If you have some, you probably want to hold it. But if you have a lot of these shares, you want to be selling. And that's what was the rationale behind here. You want to be able to sell some of these shares going forward. All right. Now, going next is that we want to look at this gentleman here, which I did talk about 2 weeks ago in the market recovery talk, my first talk in here. So make sure you check it out. And this is a very famous fund manager, and his name goes by Mr. Peter Lynch. He's a well-known Magellan fund manager, and he has a very excellent track record, right? Averaging 29.2% annual return. Don't you really want this kind of returns, isn't it? Now, it's possible. Right now, I'm going to share with you two simple tools that you can use immediately to use this, and this actually comes with a free completely. So make sure you watch me to the end. So he made his investor rich by choosing good stocks, and that's all by analyzing the company financial. Of course, we all know day to day analyzing financial, you need a degree, or you probably have to learn accounting and learn to read the balance sheet. But what we have done in VSA 360, we have made it very simple. Now, through a short demo that I'll be showing to you, you can actually pick some of those growth stocks. But before we do that, looking at those growth stocks, let's analyze and look at what is growth stock in here. Now, for a start, what is growth stock? We must look at the some of these considerations. Now, growth stocks are generally stocks that is expected to have higher than average earnings growth. Now, what do you think are the average earning growth? Very simple. Ask yourself, how much is your salary growing? Almost not growing at all, right? Now, how much is petrol price going up? Petrol price definitely going up more than 10 or 20% over in here. So when we say growing above average earning growth, we are saying in the mid-teens, at least 10% or maybe 15 or 20%, where we expect the earnings of the company, and this actually comes from growing the pie, growing the sales, and also consumer behavior, where we see a lot of this growth. Now, unfortunately, many of these growth stocks are generally technology company because their product is always changing. Just remember the iPhone, right? We all remember iPhone 10, iPhone 11, then the 12, and now the 13. So this is where the design and many of this new feature, of course, comes with benefit that enable people to simply upgrade, and that what causes people consuming to want more and more this product, and also the prices continue to stay above the average higher selling price, and also there are some premium features in those phones that can fetch higher prices that will also translate to higher earning. And of course, growth stock can be risky because if the company cannot grow as what we say, typically they say they wanted to sell 1 million phones or 10 million phones in there, and if they don't, usually the price will come down. And that's why we are seeing right now in this market where we have the inflation, and because of inflation, people are spending more money on the food and petrol. They're not spending on other items, other luxury items in here. So if you can pick a good growth stock right now, especially when the market is down, and when the market does recover, when all the inflation is under control, it will, trust me, it will be under control, inflation, then it will be a great investment. So that's what we talk about a growth stock. And of course, there are other things that you want to look at. Is a growth stock is expected to have higher above capital appreciation, right? Which means the PE, the price earning, something that you pay a bit more expensive for it. Just like we say, good things don't come cheap, and good things don't come cheap. If you want to pay, make sure you pay a bit more. but don't always overpay when it comes to buying any assets or any things that you want to use for a longer term, like just like a phone. Now, that's why we all pay a premium price when it comes to using like an iPhone, and usually iPhone are generally for those who are in a certain status in here. Now, speaking of that, the growth stock usually have higher price to earning ratios than value stocks. All right. Now, remember, there is a clear distinction between these two, where we have high growth stock and we have value stock. Now, value stocks are some of those stocks that already been discounted, been beaten down, and we know previously when in the COVID, some of those like airline stocks, hotel stocks, and also shopping mall REITs, right? Those has coming down, and also not to forget the finance and the banking stock. But right now, those sectors have been reopened. You can see some of those have started recover, right? So this is generally why when the normal economic growth that we see, right, more people are willing to pay up because they want to see future earnings of the company in here. Now, typically, companies are considered as a growth company if they have strong earning growth. Now, how do you know about the earning growth? One way is to look back the historical, the last 2 years, the last 3 years, the types of earning, and also monitoring the quarterly earnings. Now, don't worry, you don't have to go through all the balance sheet or go through all the income statement in here. All this is available on TradingView, and this is absolutely free that you can access it. I'm going to show you how to do it by just simply 2 or 3 clicks here. Now, just keep in mind, you want to see the earnings, right? And what we are assuming in here, if the company can maintain the same earnings that they did in the past, and assuming the growth path is still there, the demand for their product is still there, then it is likely to have a very good future prospect. So that is the assumption they are making, that economic growth is there, prices are maintained, people have steady jobs, good employment in here, and also credit, free credit, which is usually due to the lower interest rate regime that we are seeing in here, and more people can access to credit, then they can buy more products that we talk about in here. Now, of course, the person that we previously talked about is Peter Lynch. Now, Peter Lynch is definitely a guru when it comes to growth stock. He focused predominantly on fundamental metrics, looking at debt. So all things being the same, if he has a choice, he will look for a company that has no debts. We all know what happened to Server Dynamic, isn't it, right? Server Dynamic, a company who have a lot of debt, and right now went on to PM17. So if you look at company like the tech sectors, right? For example, Apple. I always like to use Apple because Apple can generate almost $1 billion cash every week. That's right, $1 billion cash every week. So you can see that is the power of what we call big tech company that are able to generate, because many people want their product. So all things being equal, we want a big company that is cash driven, and also earnings per share growth rate, right? We want to see that the earnings are able to grow in mid-teens, in 20%, 30%, that kind of area, and also looking at inventory over sales, free cash flows. Again, that is a very common denominator that we always see in the Warren Buffett timeframe, which means why any company that is able to generate free cash flow, then they are likely to be profitable, because that means they always have have more than they can use. Because a lot of the company that fail is because they have very bad cash flows. When a company have very bad cash flows, they tend to borrow from the bank. When you borrow from the bank, and bank usually charge a higher interest to that, and that will cause the diminishing of a cash flow that will eventually gives a very bleak future to the company. Now, Peter Lynch also looked at different category of the stocks. So he have 3 main category in here: fast grower, stable, and slow grower. Now let's do an exercise in here and see what I mean. So if you look at Nestle, F&N, what sector is it? What category is it in? Can you share with me? Just type in the answer over there. All right, come on. That's all everybody want to learn. Okay, Nestle and F&M, what are they? Okay, I would categorize them as slow grower, F&M and Nestle. The next one, you can't see there, will be QL. Okay, I just move up QL. Sorry, this side here, QL and Time.com. All right, now Time.com is definitely infrastructure, and QL is a food one. What would you categorize them? Now, don't forget, in Malaysia, QL owns Family Mart. That's right. So I would classify them as stable growth. All right. And then finally, what we call the fast growth. Okay. Now, fast growth is just behind me in here is Inari and KGB. Inari and KGB. How would you classify them? Now, these are companies that involve in semiconductors, right? We talked about earlier on semiconductors is where the big growth that we're seeing, because everything since we have the COVID and post-COVID, everyone is going more mobile. They're going for 5G in here. So that's how we see a growth, and that usually categorized as a fast grower. So I hope that this very simple categorization, according to Peter Lynch, will give you the kind of stocks that you want to go, whether you want a slow growth, you want a stable growth, or fast growth. Now, generally, depending on your age and your lifestyle, most people may want to usually categorize themselves to stable growth. Now, remember, stable growth are not very exciting company. If you look here, Time.com and QL, they are into broadband, they are into Felima, not exciting, right? Compared to fast grower, which is the Inari. They make a lot of RF chip for Broadcom, which then partly supplies to Apple in here. And then how about the slow grower? Like the FNN and Nestle. This is like watching people consuming Milo, right? Day to day, and they are buying up milk powder. So those are what we talk about, the slow grower. They're still growing, but generally they grow at the population of the country. So if the population country is generally much older, then you're experiencing about 3% growth per annum. So that gives you a pretty good idea where the market is. Now, of course, Peter Lynch also shares his insight on very important topic in here, not overpaying. Try not to overpay for growth stock. We all run into paying very high prices. Now, remember Tesla, right? Tesla was like growing at the PE of 800, right? Finally, now it's about 100, about 200 right now. That's where we people always talk about how much are you willing to pay up. Now, he said that if you want to pay, please pay at reasonable price. Go for growth company, but pay a reasonable price. And first of all, it must have sustainable earnings growth, right? Sustainable earning growth, one, which means we want to see year-to-year growth. We also want to see earnings or a quarterly growth. Now, remember the early category, we have the fast growth, we have the stable growth, and we have the slow growth. So all these are merely one is faster on the other. Now, just think of it. One will probably be a Formula 1 car, all right? One will be a BMW 5 Series, and then another one will be just your average Proton car. Now, who's going to be faster? Definitely Formula 1. So Formula 1 is like your fast grower, right? And your slow grower will be your Proton car. That is just one way of looking at it. And very important, each of these cars, Formula 1, of course, you expect to pay more. It's $1 million car. BMW expect to pay more, but compared to a Proton, which usually priced at a lower PE, but you still want them to grow at reasonable rate. Now, he always said that never overpay. So keep that in mind. First thing I want to share with you is that never overpay. All right, never overpay. So let's look at the other facets of in here. How we want to find them is basically using VSA 360. Now, remember, many of you already know what is VSA 360 in here, and don't go away. We're going to give you a free access to it. Okay, the VSA 360 growth screener is something that you all can use, and let me show you how you can use them. So what you want to have is that you can log on to the VSA 360 here. Many of you are very familiar with this and have seen it before. Let me just shrink it a bit more, right? And put in the dashboard. Okay, now we have to log in again. So once you log in, you'll be given an access in here. And once you get in here, we have the usual dashboard. And something, the new feature one is the scoreboard, which actually show, right, the top buyer and top seller. This is a new feature that we just put in. And also green pentagon counters. Stocks that has green pentagon moving higher with good news. And you can see some of these already. BJ Food, B Auto, okay, VDET. These are some of the big losers for the day. So check it out. But tonight interest is on screener. And basically we want to go on to the FA screener. You can see here, FA growth screener, that's the one that we are interested in here. So this is the list that we hear. And of course, first thing, you'll be overwhelmed, right? Wow, so many shares, but not too many. Remember, in KLSE, we have 1,000 over stocks. The growth FA screener already screened for you. See that list? we are only left with 172. All right, from that 172, we want to narrow it down because we want to give you all the opportunity that you can see. So keep this in mind in here. And of course, one of the things that we want to look at is you have any particular interest. For example, hey, I want to know a certain company, maybe the banking stock. Is there any banking stock here? So you put in finance. Yes, we have finance. You can see some of the growth in finance is Allianz, Manulife, RCE Cap, Takafu, Aeon, Bursa, still considered financial services, Apex, and Kenangan. So you can just type it in here. And let's say you want to look for technology, just type in technology. All right, you can see the technology, just fill up the whole technology. And you can see these are the company that have technology, and it is only filtering 10 out of 26. So you already narrow it down here. But I'm going to share with you a couple of tips to further narrow down and give you the criteria that we are all longing for according to Peter Lynch. We want to buy a share that is growing at a reasonable rate with reasonable price. All right, let's do this now. So we were talking about just now here the how to find them. So the VSA 360 is your first starting point. So remember, the VSA 360 Growth FA will do a universal sweep. All right, sweeping all the 1,000 over shares, filtering to 172. So it contains all the growth stocks. So the next thing is to filter out those shares that has reasonable price. Now remember, in bear market, a lot of stocks has fallen. Even some of those has fallen. They are not still wide priced well yet. And one of the indicators we look at is looking at PE, price earning, right? Now remember, always I talk about price earning. Usually for our KLCI exchange is about 14 to 15 times PE, which means that is the normal price. So anything below 14 times generally are very, very healthy, right? And anything above the 14 or 15 are considered expensive. Give an example. If you have a PE of 55 times compared to a PE of 12 times, which one is cheaper? Definitely PE of the 12 times, right? Right, compared to PE 55 times. But the company stocks with PE 55 times has a reason to stay at this very high valuation. So it is important to use the VSA 360 right in the quote dashboard to investigate why you have the VSA 360 high valuation in here. Now, very importantly, we want to pick stock that is fundamentally sound, this including income, debt level, and money made. And we want to check the stock price to avoid overpaying. Remember, investing using FA growth is like buying a house. Do you want to buy a very expensive house and also overpaid? Definitely not. We want to buy a house that is reasonable, that has a good resale value. And if we were to do a secondary resale, we can still sell at a very good price. And that's basically what we are trying to share in here. Buy an asset. Buy a share that is reasonably priced by looking at the PE. Let's continue. Now, of course, the best of both worlds in here, combining FA, fundamental analysis, and TA, technical analysis. Now, of course, our company created the Pentagon Guider, which is a patent pending in here. So basically, we have the green Pentagon and we have the red Pentagon. All right. So if you look at the green Pentagon, so we have the green Pentagon and we have the red Pentagon. So green Pentagon means tells you an up signal. The red Pentagon is telling you a down signal in here. And this is through the work of Tom Williams, the creator of smart money. So he's saying that a lot of the stocks will generally undergo accumulation because smart money really truly know what is the real value of it. But everybody else in the public tend to be misled by news, and there's a lot of market dynamics in here. Price will tend to go up, but the smart money always know what price to do. So what he's trying to say here, we want to follow the smart money. By following the smart money, we will get in at a very, very reasonable price. And yet that stock is high quality. I repeat, high quality, fundamentally sound. So this is where we first use FA. We use the growth criteria from Peter Lynch, right? And looking for those shares with reasonable price, which is using the VSA 360 in here. And then finally, we move on to the charts. Okay, this is where we use the charting, and that is strictly for market timing using Pentagon guided VSA charts in here. So if you have those two in mind, then you are actually have the best of both worlds. All right, this is our winning shares and winning trades in here, the Pentagon guider in here, able to guide you. So let's look at the growth stock in here for a start. Growth stock, there are two types, as I said before. Let me just repeat that again. One, it is type 1, overpriced growth stock. Avoid if you can, especially during bull market. A lot of stocks are running and you tend to chase them, right? But they are overpriced. So keep that in mind. You don't want to overpay. Then there are type 2, reasonably priced growth stocks. And these are the ones you want to say yes. Especially right now in this bear market, more of them present itself as a new opportunity. Don't you want new opportunity? Yes, I'm sure you want it, right? So this is where we want to look for those growth stock with reasonable price in here. So the tacit behind here is the criteria. Now remember earlier on we talked about the shares about 172. So what we want to do is, number one, step by step. First step is to look for the filtering criteria. We want to look for ST, which is the one here. Let me just share with you. And okay, just erase this. You can see this is the ST, stand for short term, LT stand for long term. So we want to look for those that is, given the all things being right, we want to look for green and green. Green and green. That tells you the stock is ready to move higher. However, there are some stocks are red and red. That tells you the market is very still bearish. So what we keep in mind is that we wait. We do the patient game. Now to make money, you all know, right? You have to be what? You have to be patient. So this is where it's like waiting for the train to go. We onboard the train while waiting for the train to be ready, but we sit there and maybe we collect some dividend, right? So that's one way of doing it. So that's definitely one benefit of buying shares that is really beaten down. Now early on we talk about a share that is beaten down. We look at the intrinsic value. We can combine with Smart Robie looking at it. Then that will tell you how the true value of the market. True value of the market, because the company shares is still growing, the earning is still growing, they got plenty of cash. So it is a company that has good fundamental. And if you buy those shares and like a train waiting for it to go, and during that train, guess what? They serve you coffee, they serve you nasi lemak, they serve you drinks. That's like dividend, right? Yes, that's like dividend. You're getting this dividend in here, and that's what is this all about. It's about buying those shares ready to move, just like the train ready to move higher, and yet collecting dividend. So very important point number 2, avoid overpaying or overgrowth. Avoid paying overpriced and growth stock. Those come with Robie rating of NA. All right. Now third one, always best look for Robie rating with 3 and above. And that's all the whole one thing we're going to do. So what we want to do right now, we will manually select them. So I'm just going to share with you how we'll be selecting them. So let me just bring up this again. So from here onwards, we want to be selecting, we know some of these. First of all, we select the stock first. All right. Then only we go for the timing part. Now remember, when it comes to timing, we look for ST and LT. ST and LT, green. So we need to get both correct. The FA correct and then the TA correct. So usually I start with FA first. Then from FA, then I go to the TA. All right, keep that in mind. But you can do TA first, then also FA, depending what you want. But follow me, do FA first, then only do TA. So from here, technology, I can see DUFU is industrial, and I click on DUFU. Okay, so when I click on DUFU, it takes me to this screen in here. We just wait for a while. While it's fetching, oh, I stayed too long. I have to log back in again. So I'll click on DUFU. Turn this off. So you can see DUFU first of all, right? All the indicators here. It is a large cap. It is number 5 out of 282. That's this ranking. The higher is better. It is number 3 out industrial material and component. It is a main board, is Sharia. It is a growth stock. It is a long-term stock, and it is GaRP, growth at reasonable price. This is what we talk about. GaRP. So GaRP is growth at reasonable. So this gives you a 4 out of 8, a very good fundamental stocks. Okay, so fundamentally it's very good, but the stocks, as you see from here, are already been beaten down a lot, but it's starting to make up. Okay, so we can go on to the here. You can click see from here, and so you can see the stock started to move up. This is very nice actually. This is a good stocks, and let's see whether they pay any dividend or not. All right, Dufu, yes, they pay a small dividend, 1.63%. So already started to move up, and this can be a candidate for you. All right, having said that, let's take this one here. So this is how we look for it. Let's say we are looking for green. All right, let's take a look at another one. So this is Dufu. Let's look at, maybe we are looking for consumer. Okay, let's look at consumer. Yes, consumer. We have P Trans, Harrison, QL. Then remember QL, B Auto, GCB, right? Magni and CIDC. Okay, so some of these stocks you may have preference, some of these stocks you don't have any preference. So sometimes when you go to a newspaper or certain gurus say about these, we all know right now BJ Food. BJ Food is very hot, right? BJ Move have made a big move, and you can see from here the last 6 months here, all right, how much percentage he has moved. So you can see here, these are stocks that already move up. And generally when you buy growth stock, right, you want it to start to move or beaten down where we do bottom fishing, right? So if you want to buy Berjaya Food, the stocks already move up. So you have to be very, very careful too, right? You can look for stocks that has not moved up yet, maybe like QL Resources, which is a green. All right, let's look at QL Resources, which is a growth stock. So next thing we want to do is check what? We want to check the Robie rating. All right, so we click on to QL, and you can see rating is NA. So when rating is NA, remember I talked about the PE. This is PE 56. So it is a growth stock, but unfortunately the price is very expensive. Okay, PE is 56 times. So in here, we want to look for those that is. Let's take a look at another one, B Auto. Let's take a look at B Auto. You can click on that one. B Auto, wow, look at this one. Very good, isn't it? 6 out of 8. PE of 13 times and ROE of 24. And also analyst has it at 2 ringgit. Right now is 180, about 180. Today is about point. So this is definitely a good stock, and this is a long-term stock, but unfortunately it's not a GaRP. GARP. Okay, GARP is not the GaRP. Right in here, you can see not a GaRP. So this basically it is what we call a good rating stocks. It is a growth stock, but it's not growing at the reasonable rate because we want it to grow, right? If you don't have any choice, maybe this will be my second choice for B Auto. All right, so all this stock, and guess what? B Auto pays what? There are 3 ticks here, so each of these tick means it is recommended. Okay, very good, means you get our point now. All 3, that's why you got 6 out of 8. It is one of the highest rating in here, but then again, not many people are excited, right? So after this car sales, and remember we all know car sales did very, very well because last year when the COVID, there was a lot of incentive for people buying cars. And if you can see that some of the news, Kenangan earning beat, okay, BJ Auto net profit up, and this is, you know, riding on a net. But going forward, do you feel that this is the sector that will have growth because it is basically an automotive industry in here? All right, so I would go on to the other sectors. Let's take a look at another one, financial services. This time we are talking about financial services. So financial services, we have Allianz, we have Bursa, okay, and you can see Allianz hasn't gone anywhere. Let's take a look at Allianz. Click on that one, and this is how we are. It's rated 4. Okay, now also take note, you have this little trap here because the PE is only 4. So usually when PE is 4, you have to be very suspicious. You know why is Allianz so cheap? Very cheap discount. ROE of 12% and a dividend of 5. So you need to have more investigation in here. And of course, this company in here has paid a 5% dividend in here. Extraordinary profit, very high dividend yield, very tangible to price, cash rich, of course, face stock dilution because the stock has been overly so-called been split, been split again. So very low gearing, very high volume in here. Stock's not bad. It's an insurance company in here, has done pretty well over time. And also you can see other things that usually we look at consideration here is look at the average return over the last 6 years. You can see average return over the last 6 years is only about 5%. So this hasn't, in the past history, hasn't been that growing. But in terms of earning is growing, but the price did not grow. Okay, no doubt if you are learning. So if you look at Allianz, what would you classify them? Is it a stable growth? Is it a fast growth? Or is it a slow growth? What would you think? Insurance company in here. I would think it is stable growth. Okay, my assessment here will be a stable growth in here. But again, you're buying these shares, but not at a reasonable price. Okay, so we have to look for GaRP. Okay, look for GaRP. Okay, let me talk about the GaRP, growth at reasonable price in here. I hope you're enjoying this in here. And for those of you who are watching in the video, right, in the tutorial, make sure you re-watch this again. Now, the VSA 360 criteria for type 2, growth stock at reasonable price. And generally, this is what we are looking for. We want to see the company growing earnings year by year, or at least the last 3 quarters. PE must be reasonable between teen to mid-teens, which means we are looking for PE around the 15 and 17, but no more than 26 times PE. All right. The ROE must be 12% or higher. Now, one of the new things that we'll be doing, we will put the new GaRP checklist on the screener. Now, early on, you will notice, right, when we have this, we don't have this GaRP here. So eventually, we'll put a GaRP here. When you click on the GaRP, just like the other screener, it will automatically filter out those from the 172 list. That makes it so much easier. So that is one of the new enhancements that we'll be doing. Now remember, when you subscribe to VSA, you're not buying a dead system. You're buying an ever-changing, ever-evolving to demands to your needs, demand to the market needs, and also based on the coaches and consultation with you to build those features to help you to make money. Now remember, when you subscribe to VSA 360, we want you to use VSA 360 to help you to make money. And that's the bottom line of it. All right. So here, so now you know this. So the sweet spot. Now the sweet spot is basically what we want to do is to find the VSA 360 growth and together with Robie rating. All right. This is the sweet spot. So you want to find Robie rating as high as possible, but it must come from the VSA 360 FA growth. And if you have that with the reasonable, what we talk about, ROE at least 12% or higher, PE between the mid-teens and slightly low teens, and growing earnings per share. So those 3 criteria. If you have done that, then you're in the sweet spot to enjoy growth, but at a good price, which means you're buying at a very good price, not overpaying for the stock that is growing, right? And enjoying that growth that will come. All right. So here are the manually filtered. I've done the filtering for you, right, to find out those shares in here. Looking at GaRP shares, growth at reasonable price stock, VSA 360 with high Robie ratings. All right, and it's a manual selection right now at this time during this bear market. Now remember, this list will change from day to day, week to week, depending on the market circumstances, depending on the PE, depending on the earnings. So when you come back and watch this again sometime in the future, you will see this list may change or this list may go higher. The prices go higher. So right now, Dufu has a rating of 4 out of 8. Bursa has a rating of 5 out of 8. Now remember, early on we found B Auto, but B Auto did not grow at the reasonable. It is a growth share, but it's not at the reasonable price in here. Bursa 5 out of 8, BJ Auto 3 out, Berjaya Food 3 out of 8, and Syntex 4 out of 8. Now keep in mind, if you have a higher Robie rating, like what we talk about B Auto, it may not be a necessary growth stock, as I said before. You know, it is probably a stable growth. But so know what you're buying, and if you're going to keep it. Robie rating measures the valuation of the company. The higher is better, meaning you're getting better value, right? Meaning they are more likely that stock is been heavily discounted when the Robie rating is high, and vice versa. If you get a Robie rating that is 1 or NA not rated, chances is that stock is highly priced and overpriced. So keep that in mind. Look for what we call the sweet spot. All right, keep that in mind. Looking for the sweet spot for that one. So here Once we completed the stock criteria, now we do the market entry, right? Just imagine we selected those 4 stocks in here. And remember, green pentagon is up signal, red pentagon is down signal. That's all to it. Very simple to do. And this system was created by our company in here and by myself, Pentagon Guided in here. And it's available for you to use. All right, it's available for you to use. So right now, let's do an exercise for the FA growth. And of course, when we doing it right now, because we are in the bear market, we want to hold it for a longer period for investing. We recommend you to use weekly chart. All right, use the weekly chart to do your profit target, your stop loss, and then look at reward to risk. All right, let's do that. Okay, reward to risk. Sorry. All right. So first one we found out was DUFU. DUFU is a GaRP Share, right? And we're going to be using this. Let me just bring out my calculator too. Then because we need to calculate the risk to reward. So let's take a look at DUFU right now. Okay. DUFU, yes. Okay, close this off. Okay, we'll switch to here. And DUFU, let's switch to a daily chart first. Now, we all know DUFU was a 4 out of 8. And how we don't know that? You can go back to here. You can look for DUFU. So this is what you will get, unlike any other system out there. DUFU is 4 out of 8. You can see it is a good shares. And it pays a small 1%, but it is a growth stock, small dividend payout, positive, low gearing, very low price to tangible asset. And right now it's been beaten down from previously it was about above $3, went down to 2 something, but has now recovered. Okay, now has recovered. We can also look at some of the other news that DUFU has, staging breakout. On net profit, no wonder the net profit is doing well. I do think they are in the hard disk. So if you want to know more about the company, you can always go to this in here. Okay, just let me just scroll up a bit here, and you can look at the company website. If you can, yeah, it's coming up in here. Oh, it's in decision position, and you can check it out in here. Of course, all those. The other thing is. You can also look at the, this is show me the money. All right. If you have invested in DUFU, okay, let me just blow this up a bit, right? Your 10,000 ringgit were worth 6 years ago, 174,000, right? So this is why we talk about building wealth over a longer period, rather than you want to be in and out. And depends whether your perspective of a longer. For me, I'm also more of a longer term investing stocks that is growth, all right, that we talk about. But most important, having that sweet spot, not overpaying. Make sure you get a very high Robie rating, as high as possible, and growth at a reasonable price with a lower PE, but still pays a little bit of dividend too. So keep that in mind. So I hope that this video will give you some insights into that. So we were talking about the DUFU. Let's go on to the stocks here. So we have DUFU. Now remember, DUFU, all right, or just turn green pentagon on the weekly chart. Very, very nice entry in here. All right, let's say we decided to enter maybe at the lower support here at this price, 255. Okay, so 255. Let me just put in here. Okay. Okay, and enter. Let's say 255. If you want to enter higher, also can, but we're saying for this one, we're just using as a example here. All right, 255. Where would we put our profit target? Okay, so we go back to the old high. Usually we just go back to the old high, or you can use Smart Robie. But because we are riding for longer term, and it has a very nice setup. We have a double bottom in here. You can see this is the pattern that I talk about market stages. So when we go on to market timing, I will talk more about that. But today I just want to focus on the FA due to the short time that we have. All right, so the FA is here, and then we put another one text here, and around, let's say, 440. Okay, so we will target profit 440. Okay, so once we have that, where would be our stop loss? So because our stop loss, we want it to be somewhere just below here, $2. Okay, $2, maybe 210. Okay, 210. Okay, Stop loss is 210. Okay, so if you're with me, just type in your answers there. So if you make sure you're following it. All right. So once we have that, we compute our mathematics. Okay. So our mathematics, we want to calculate the reward to risk. Now in Pentagon Guided, if the market do come back, it has about a 65 to 70% chance of winning this trade. All right, 65 or 75% chance of winning this trade. So usually what we want to do here, we will type the reward to risk 4.4 divided by entry at 255. So that will give you I need to calculate the risk to reward. So 440 minus 255. Okay, so that's 185. 185 is the reward. Okay, so what we do is we put the reward at 1.8 here. Okay, so the reward 1.8 is the reward. Now we had it earlier, right? Profit target is 450, right? Is it 450? Stop loss is 210. 450 or 440. Okay, somewhere. So 1.8. Now we want to calculate the risk. Okay, let's calculate the risk. Risk just now we had it at 255 minus 210. So we have 255 minus 210. So that is 45 cents. All right, so we go on to our here. Okay, 45 cents. So what is the reward to risk? I think the reward to risk is very, very good. All right, so we have let's see, I can do this now. Oh yes, I think I can. Oh no. So 1.8 divided by 0.45. That is almost 4 times. 4 times. Very, very good reward to risk. And usually we want to go for something that is at least 1.8, 1.6 and above. So this is a very good reward. So that is one example. Now you can re-watch this video back and recalculate how I did the profit target and the stop loss and reward to risk. Okay, let's do a second exercise. Now that we have selected the stock, we are looking for the market timing. Right, the next one we're looking is sign text. Okay, now let's take a look at sign text in here. We can look on to sign, turn this off. We go to sign text. Okay, SCI. Oh no, this one is this used to be Daibochi. Okay. Sign tag. Yeah, that's the one. So sign tag is 4 out of 8. It pays a 2% dividend. Not too bad. I always like it, right? P of 12 times. Remember I talked about, right? The 12 times is very, very good because the KLSE usually is about 14 to 15 times. So you're paying at 12 times, ROE of 14. And guess what? The analyst has it at 4 ringgit. Now this is an analyst that we pick up from through our intelligence gathering in here, 420. So it does provide a 15% upside. Okay, so you do have a safety level in here, about 13% in here. No doubt the Pentagon Guider right now is at red Pentagon, so it's not time to buy yet. But let's do the same planning like what we did. So here we will change to sign text. And remember, Signtech, the last 2 days came out, it does has a very, very good performance. Of course, when you switch to a daily chart, for the shorter time frame, he has turned red Pentagon. But because we are trading for longer term, we switch on to a weekly chart. All right, so this is where Pentagon guided. Now, let's say for this one, you want to buy around 236, maybe 1 or 2 weeks from now. Okay, you want to see that market start coming out. But again, very, very similar to what we have in Dufu, a double bottom in here. We have this double bottom. So from a chart perspective, we are very, very close to the bottom in here. All right. So let's say if you decided to buy, you want to buy lower, 350. Okay, 350. Okay, 350 here. Entry is $3.50. Okay, and where's the stop loss? Okay, so stop loss, we put it just below here, 335. Very, very low risk. Okay, 335 here. Stop loss is 335. Okay, so that's what about profit objective? Oh, profit objective, you can go for the old high here, maybe around 460. Okay, 460, because we're going to go up to 460 in here. Most important, make sure you have a 1.8. So let's say you calculated the risk is 50 cents and you want to have a 1.8. So 50 cents times 1.8 will give you a target or price that makes that trade worthwhile to do. So here just now we were saying is 440. Target profit is 440. Okay. So after 440, we have all the necessary information in here. Let's do our trading plan. All right. So Sindex profit target is how much? Okay, profit target is 440. So let's write that down. Okay, 440 is the target price. Stop loss. What is the stop loss? Just now we calculated 335. Okay, and we look for the reward to risk. Okay, if you're going to look for a reward to risk, we will use our calculator. Somehow my calculator is okay here, and we have Sindex 440 minus 350. Am I correct? 440 target profit, entry 350. Okay, 440 minus 350. So that's 90 cents. Okay, so we write down 90 cents here for the reward. Okay, and now we're going to go on to looking the risk. 350 minus 335, 15 cents. Okay, easy lah. That one easy. Can calculate, right? 15 cents. So you divide it by 15 cents. So what will be the reward to risk? Again, we prefer it to be 1.8 above. Okay, so here we use the calculator. Okay, 0.9 divided by 0.15. 6 times. Whoa, goodness, that's good, isn't it? Is that good or not? You tell me. Good, right? Yes, that's right. For those of you, so that will give you more than 1.8. Then that's good. Okay, so that's all right. So make sure you catch a snapshot of this. If not, you can always re-watch back this video and see how I'm able to pick up those stocks yourself. All right, pick up those stocks yourself. And let's go on to the next concluding slide that I have for you here for tonight. So unlike many other software out there, or the Pentagon Guider and the VSA combine both fundamentals, which tonight we are looking at growth stocks, but those has been beaten down, especially this bear market. Then we use the VSA market timing, right? We look at the company market condition here. We believe these two will help you to make the best possible decision possible today, right? We cannot guarantee you will make money, but you have seen the reward to the risk. It's a very good calculated risk to take, where you stand a chance to make money over a little small risk. You only risk 15 cents, but you get 90 cents. And this is how you get better returns for your investment. Now, of course, you can see here, just now I shared with you, you can always go to VSA 360. You can look for GaRP, G-A-R-P, right? And it's rated 5 out of 8 in here. Previously was higher, now is 4. Remember, previously it was 5 when I was doing this slide. Now is 4, because as the price move higher, the Robie rating is dynamic, so it's actually get lower. Of course, when DUFU goes even higher, it may fall to 2 or 3, not so attractive lah. So the higher of Robie rating it's the same thing. Houses is always best to buy when they are cheaper and during a bear market. Okay, so we have demoed the VSA 360, but we'll give you a chance for you to check out through our TradeVSA 10-day trial. If you want to try out that trial, use this QR code and fill up the Google form and schedule a coaching session with our trainer Zach in here, and you will go through the same thing, have the all the touch and feel, the bells and the whistle in here, and have comfort, have safety, assure that your stocks of picking up those growth share are taken care of. All right, so you can activate this tonight. And of course, for those of you who are ready, sign up in here. We have a very good package. Our combo and our plug-in package in here will get you in here. It will give you the first mover advantage. Future update includes the US market in here, right? We want to perfect the combo FA and TA for our Malaysian market in here, but we included in here. So GaRP is something that I hope I have shared with you, and you learn this growth at reasonable model from a model of Peter Lynch. Now, of course, don't forget to join our Telegram chat room in here for more information. And we really appreciate if you can go over Google Play Store if you're not done so, right? And give us a review on our Google Store in here. We really appreciate and thank you for your time spent with us. That's all we have for tonight. And if you have any questions that you want me to answer, just pencil those in there. Else, I'll see you in the next tutorial that we're doing on the live Facebook using the VSA 360. Great wonders will help you when you trade smarter every time with VSA 360. Thank you again.